Hi guys, and first of all, this is the last lecture of the Titan model. I know it has taken a lot of time for us to reach here, but this is how you actually need to learn how to make financial models, right? It has to be this detailed, and you have to, spend some time, be patient, spend at least a month, especially when you're first getting started with making financial models. So we are in DCF valuation, and this is like the most weighted moment for any person who is actually making a financial model to know what his research is finally going to yield, whether it's going to be undervalued, overvalued, and there's going to be some tricky situations also when we are going to talk about terminal growth rate, right? So I'll be talking a little more on terminal growth rate because that's what is going to finally, decide what kind of valuations we're looking at for Titan, right? Now remember that if you've not spent a lot of time initially in the revenue research, it will be very difficult for you to gain that conviction at this stage. But, anyways, let's get started and try to conclude the entire Titan model in this lecture. Hi guys, and welcome to the final session on the valuation. So I'm going to save this sheet as DCF. So in case you want to see to the solution file directly, you can always refer to this file. So I'm going to save this as DCF Titan. Okay, so we're on the final leg, and one thing to understand about valuation is again that what kind of a valuation model are you going to use, right? Because DCF, what are we finally going to use? So if you remember the first session that we spoke about free cash flow, right? Now, in order to understand whether to use FCFF, free cash flow to the firm, or free cash flow to equity, you have to understand that what is the capital structure of the company, right? Now you can clearly see here that in the long-term borrowing section of the company, right? So if you go to the liability side, you'll see that in terms of long-term borrowings, the company does not have much of borrowings except lease liabilities, right? Now these lease liabilities are basically operational borrowings, so we can't really say that the company has a lot of debt, right? And all of these borrowings that you actually see, these are mostly working capital borrowings, right? So hence it would make sense more to use an FCFE model, the free cash flow to equity model. Now before that, of course, you need to write down what is the various values, right? So first is, in any model, whenever you're doing DCF, first start with writing the capital structure, right? So structure, and write down whatever the equity values are there, total equity. So it's better to write total equity, total debt. Okay, then you'll total it out. So let me just put this column out here. Now you can write here values, and then you can write proportion here, and you can also write the cost. Okay, so total equity values, again, balance sheet. Let's go to our equity side. So that's our total equity, right? So for FY23, this is the total equity. Debt, long-term borrowings is very less. In fact, the company's long-term borrowings actually been paid off, right? But if you wish, we can also, while doing the iteration, we can also consider, if you want, the lease liabilities. The only thing is that we'll have to understand what the lease liability structure is, right? So if you want to see, we can go and look at the annual report of FY22. Okay, so FY22, we can check if this lease liability would fall under borrowings if you want, right? So let's go to the consolidated statements. All right, so consolidated statements, we can come to lease liabilities, and the note is on 14.1, and so we can actually see 14.1 and 14.2, but the 14.1, the 2 crores of debt has actually been paid off. We can also look at 17.1 in order to just to be sure on what these borrowings mean, right? So let's start with 14.1 first. Okay, so you can see here 14.1, which is the 2 crores, is nothing but secured against the corporate guarantee issued by Titan Company Limited at an interest of 0.5% per annum. So absolutely non-existential. The effective interest rate of the term loan was 8.19% and is payable on 48 equal installments. But this has already been paid in FY23 when we look at the Q4 update. So there's nothing much we can do about this. But let's look at lease liabilities. So if you look at lease liabilities, we've been sent to note number 29 to find out more values, more details on this. So let's go to note number 29. Okay, so maybe we'll find some more details on this. Okay, so you can see here these are leases for buildings, leasehold land, plant, machinery, etc., right? And you can see that not much of information actually is given, but these are mostly operational, you can say, leases which have been taken, right? So it's very difficult to actually count this in terms of long-term debt. So that's the reason why I have skipped it. So the only reason I've discussed that is so that you understand why we are not taking any debt out here, right? So basically, total debt I am considering as zero, right? So entirely an equity company, right? But what is the cost of this equity, right? So that is where we use the CAPM model. So risk-free, beta, return on market, and that will give us cost of equity. So if you look at the current values, I already have these values, so you can check the current risk-free rate. It should be somewhere around 7.2%. The beta of the company is at 0.59, but you can check the updated values at whatever time you will be solving this model. If you look at the long-term returns of the equity markets, it's about 15% in India. So when you actually calculate the beta, that would be RM minus RF multiplied by beta plus RF. Okay, so that's about 11.8% cost of equity. This is why the stock actually makes a lot of sense, because the ROC generated by the companies is around 26-27%, whereas the cost of capital that they actually have is around 12%, which makes 25% minus 12% as the net increment in value that the company is actually giving you in terms of the stock, right? So we've calculated our CAPM. Now what we need to do is we need to get our free cash flow, right? So the DCF model that we're going to do. Now we're going to use, since this is a growing company, we want to actually create a two-stage model, right? So two-stage model would be, first is, or you can actually say a three-stage model, wherein we first, couple of years which we have forecasted, the first 4 years is going to be the explicit forecast, right? So let's write here. So this is 0. Then the 4 years between 24 and 27 where we are actually forecasting, right? So 2024, 25, 26, 27. So this is our explicit forecast, which we did it using our various research, right? So this we can just mention it as explicit forecast. Now the reason why we are actually using a three-stage model is because the company is still growing and the market share of the company is still way far from a mature company, right? So first is the explicit forecast, then we look at linear growth. So another 4 years we can probably assign it growth, right? And then post that 4 years we will take it as linear decline, right? So let's put some colors to just it is easily understandable, right? So that's your basic timeline in terms of the model. So a mature company, it will just be explicit forecast and linear decline, right? In case of a growing company like Titan, which is far from being mature company, we will be taking the three-stage model. Okay, so now let's start with the FCFE formula, which is net income plus depreciation plus changes in working capital, right? Capex, and we don't really have any borrowing, but we can still write debt raised and repaid. So that will give us FCFE. So we can start getting the values in place, starting with net income for 24. So that's 8573 plus income statement depreciation for FY24, which is 403. The changes in working capital, you can just sum it up from the cash flow statement out here, right? So these are all our changes in working capital. Capex from again the cash flow statement. Right? And we don't really have any debt raised and repaid. So I'm going to sum this up. Okay. Just to check this again, changes in working capital, we'll just cross check it in FY24. Right, so that's inventory. So this is our basic working capital account 7568. So the value seems to be matching, right? Now what we'll do is we'll just copy this across for the forecasted period, right? There you go. Now how do you forecast for the future periods, right? So what we're going to do is we're going to find out what the growth rate is. I mean, this value is obviously you can skip, because the first year, as I had told you when we were forecasting, the major changes are going to come because of inventory. So that's why we're just taking the growth rate for this period, right? And what we do is we just consider that 3 years for the linear growth phase, it will keep on growing at the same rate that it was growing at year 4, right? So we'll increase the cash flow at the same linear growth rate. Okay. And post that, in my theory, in my assumption, so if you can see, your cost of equity is around 11.8. My understanding of the company and the business leads me to say that the cash flow of the company is going to grow for a long period at a 10%. So I'm assuming that the terminal growth rate, okay, growth should be at somewhere around 10%, because if I'm saying 5% or 2%, then I'm talking about a market which has already matured. But even in the presentation of the penetration of retail and online and organized versus unorganized, we are clearly seeing that we are far away from even the global picture, the averages of the global picture. So that's why I've taken a long-term linear growth rate of 10%. So in the linear decline phase, what we're saying is this growth rate will constantly keep on coming down until it becomes constant at 10%. So the formula that you can actually put is last year's value minus, now we need to get that constant decline value, right? So it is going to be 22% minus the long-term growth rate divided by how many years do we have? 1, 2, 3. Right? So we can get that 3 values, and let's just put it in percentage. So it's coming down 18, 16, 14, and then it should come, or maybe we'll just do it 4 just to see whether it should, yeah, so that's perfect. It's a 19, 16, 13 and 10. So again, increase the cash flow until year 12. So what we are saying is beyond year 12, the cash flow, the free cash flow will remain constant at 56,635. So, but again, the company does not stop here, right? So the company also goes beyond this, right? So what is the value that we're going to assign for the going concern? That is where again the Gordon growth rate value comes in, right? So what we will do is now we will find out the terminal value. So the terminal value formula, as you might know, is the last year's cash flow plus 1 plus terminal growth rate divided by cost of equity minus the terminal growth rate. So that gives us the going concern value. But again, all of these values have to be found out in the present terms, right? So let's write present value. And now let's just divide the cash flow by, so in fact we can sum this up all together, divided by 1 plus cost of equity raised to the number of years that you want to find out. Okay, so that seems fine. Now let's calculate the equity value. Basically what this addition will tell you is the equity value itself, right? And number of shares, as we know from the income statement, is 119. So intrinsic value will be dividing it by 119. So our intrinsic value is coming out as 8881, whereas the current market price of the stock is around 2,700. You can just quickly check. It's 2703. So we are looking at a upside of almost 228%, which I don't feel is a very large appreciation. I feel it definitely has the potential to, when the stock or when the company or when the market will start pricing it at this value within the next 3 years, right? Considering the kind of growth that the company has actually been giving for so long, and this might actually be even much higher if you actually look at even a 10-year period. Probably the expectation of its market cap. So out here you can clearly see, right? So the equity value we're saying is around 1 lakh crore, which is very similar to the equity value or the market cap of TCS, right? And this is where a lot of analysts and a lot of fund managers do expect this company to reach, provided that the company keeps on performing in the coming period, right? So that's our intrinsic value of the stock. Now, of course, we can do some sensitivity of this DCF model. So majorly you want to sensitize against the terminal growth rate of 10% versus the cost of equity, right? So any of these two things might change in the coming future, and how will this actually affect our cost price, right? The stock price, intrinsic value, right? So what we can do is we can start putting on the one side, I'll rather make it here. So we can call this as terminal growth rate, and we can just wrap the text and change the direction of the text. So let's just do some alignment here. Okay, so that will be our terminal growth rate, and we can just put some simple colors to make sure that it is easily visible, right? And on the top front, right, so you've taken almost that would be 8 variables, and we can do the similar thing out here as well, right? Somewhere around 8 variables on this side also, and we call this as cost of equity. These are the two major things which actually affect the stock price. And what do we want to check? We want to check the intrinsic value. What will be the intrinsic value if all of these values change, right? So in fact, let's put the values first, then we can actually start the analysis. So terminal growth rate, so currently we have what, 11.8%, sorry, 10%. So let's try to get some variations out here. In fact, we can start below the terminal growth rate at 8% as well. 0.5%. Let's try to increase that to a little bit more so that we also get some upside values. So let's make a change of 1%, right? And let's get the cost of equity. So cost of equity currently is at 11.8. So we can start with anywhere above 9% and increasing it by 0.75, and you're free to add any values, right? I'll just try to keep a little slow because it won't make any sense. It is just trying to get values more than the terminal growth rate, otherwise the calculation will get into an error. So that's our intrinsic value. So let's just put some borders out here. So we want to sensitize the intrinsic value out here. So let me just put some right border, and let's select the table, go to data, click on what if analysis, data table. Now row input, as you can see, is cost of equity. So we'll select cost of equity, and the column is basically nothing but the terminal growth rate, which is coming up from here, right? So let's just decrease the decimal place. Now these errors basically are happening because of the value is not matching, because if cost of equity is 12% and if your even the terminal growth is 12%, of course the denominator becomes negative, right? So that's the reason why you need to make sure that your values of terminal growth rate, I mean the way you structure the table, right, is that your cost of equity is higher than your terminal growth rate, right? Otherwise the values will not actually make sense. So if you can see here, 10% and 10% doesn't make sense, right? So that's the reason why I was actually making the changes, so that it does not give us any negative values. So let's keep it at 8, 9, 10 is again not making sense. So we can start this from 10.5% then, right? In fact, what we can do is we can start with 5% as well. Yeah, so then we don't have much errors out here, right? So you can obviously keep on playing with these numbers, but what we're essentially saying is that if the cost of equity is 10.5 and the terminal growth rate, we get different terminal. Actually, this column is very interesting, right? This is what actually is the main analysis. So if you just highlight this a little bit, you'll realize that maybe we can go wrong with the terminal growth rate assumption also, right? So even if I say that the cost of equity remains same at 11.8, so let's just put 11.8 here just for a second, okay? And we say that the terminal growth rate is 6%, right? So then the valuation is nothing very interesting, right? But as soon as we're looking at anything above 7 odd percent, then we are essentially saying that the stock is becoming extremely undervalued at the moment, and we are missing out on a lot of value, right? And that is where the conviction has to come, right, about a stock. Because when you're looking at a long-term investment of the company, if you calculate between 2023 minus 1987, it's almost been 36 years. The company is still growing at 20-30%, right? And usually whenever you look larger companies in India, including ITC, right, they grow at 15-20% since ages. That is where the conviction is on the 11% terminal growth rate or 12% terminal growth rate, wherein the stock is nowhere even close to what our DCF model is actually saying, right? So that is where one of the conviction is. And second of conviction is obviously because the company is a very clean company, and very trusted management, and does not passes all the forensics, because of which it makes the company very reliable in terms of their value. And in India specifically, the major problem is not getting cleaner companies, right? So there are various companies that you will get in India, which will give you good numbers, will show good numbers, but it's very difficult to believe, and most likely, you will not be able to sustain that kind of performance. And there are various examples. So that's how you actually do the DCF valuation. Be aware that whatever models you're using, whether it is a two-stage model or three-stage model, it has to be based on what is the stage of the company. So here we are very clear that the company is long far away from actually become a mature company. Hence we have used the three-stage model. And I'll show you what exactly happens wrong if I actually take only a one-stage model. Let's say we were making only 4 years of forecasting. The problem that would arise would be to what should be the value for the long-term terminal growth rate. So obviously, if I just put 10% out here, but the company is far away from growth, then my valuation will come, valuation of the company will not come correct, right? Because year 4, that means 2027, is not the time when the company is going to get matured. The company is not really reaching a maturity stage. That is the reason why we use linear growth stage, where we are saying, okay, another 8 years is definitely going to be the stage for company to keep on growing. And then post that, although the company can grow beyond that also, but we are saying that, okay, for post that, the the company enters the maturity stage and the growth rate keeps on reducing. So that's the end of the Titan DCF valuation model. I hope you enjoyed the session, and if you have any questions, please do feel free to put it in the forum. I'll be happy to assist.